Live from Sydney, this is Insight with me, Stroud-Watts, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, China battles continued deflationary pressures with consumer prices falling below zero for the first time in a year in February. Weak data from China and the US fueling growth concerns. We'll be talking Chinese consumption with our exclusive interview with the Pepsico APAC CEO, Ahmed, and take a look at the trends that they're seeing on the mainland. Plus, getting the outlook for cryptocurrencies with Coinbase and Chainalysis after Donald Trump's executive action when it comes to a strategic Bitcoin reserve disappoints. Markets looking pretty unsettled at this point at the start of this trading week. Fears about the broader US economic growth, a slowdown. China's inflation proving that further stimulus is needed. That dip below zero for the first time in a year, despite, of course, some seasonality at play there when it comes to that reading. But if you take a look at bond markets, traders there signaling an increasing risk the US economy will stall. Traders are piling into short-dated treasuries, expectations that the Fed could cut interest rates as soon as May. And in China, investors looking for signs that the government stimulus is translating into stronger domestic demand. And of course, so much of this enthusiasm is still being seen when it comes to Chinese equities, where that performance gap between China and the US continues to grow. Let's take a look at what we're expecting, though, when it comes to that boost to spending, further stimulus for the economy while facing a trade war with the US. Bloomberg's China correspondent Min Loh joins us now from Beijing. Economist David Chu joins us from Hong Kong. So great to have both of you with us. Min, I'll start off with you. To an extent, the inflation numbers didn't surprise, but it certainly just reiterated the kind of state when it comes to Chinese households, consumers and broader confidence.
Yes, pretty weak numbers in January after that bump, weak numbers in February rather after the bump in January because of Lunar New Year. You have the seasonal factor there at play because Lunar New Year in 2024 fell entirely in February, so there was a high base to work off there. And there you can see that big drop in food prices, 3.3%, weighing on the overall index. But if you strip away that volatile food and energy prices, you look at the core inflation, also in contraction, 0.1% down compared to the previous year. The first time it is in contraction since 2021, and only the second time in about 15 years. That just shows how serious this deflationary spiral is. And of course, in March, I guess that would give us a better sense of whether the government stimulus policies are helping to reflate the economy after you take away the seasonal factors. Of course, investors are waiting for more details in terms of how the government will boost domestic consumption. Last week, the economic planner said that they will be releasing a government action plan. More details from that that we are still waiting for. And over the weekend, we also had the Livelihood press conference where the Ministry of Social Security and Human Resources mentioned that it's going to be an arduous task to expand and keep employment stable this year. You have 12 million new fresh graduates entering the job market come July during graduation season. That's when you can see more pressure in the job market, perhaps more downward pressure on wages if the government cannot meet their target of creating 12 million new jobs this year.
Of course, this comes at a time when there's a flurry of tariffs, reciprocal and otherwise, between China, some of its trading partners, including the US, including Canada as well. So just adding to the pressure.
That's right. So China's retaliatory tariffs on the U.S. on a range of agricultural goods is starting today. It's taking effect today. And at the same time, over the weekend, the Chinese Commerce Ministry also announced that they will be imposing retaliatory tariffs on Canadian goods, 100% on rapeseed oil and about 25% on Canadian pork and other certain seafood imports. That will kick in on March 20th. So you can imagine that that could possibly raise prices of imports into China as they impose these retaliatory tariffs. Of course, there's still a lot of risks in terms of what more tariffs could be imposed in the coming weeks and months, because Canada has been under pressure from the US to match those tariffs on Chinese goods. And that could be why we're seeing China retaliate at this time, perhaps firing this warning shot to Canada not to impose further tariffs, showing that they are willing to retaliate aggressively, matching those tariff rates like for like, which is quite in contrast to China's stance towards the US, where those retaliatory tariffs have been largely less than proportional, signaling that there's more room for dialogue with the US, but maybe not so much with Canada.
David, it's a fine balance, isn't it? Because on the one hand, you can see why Beijing is perhaps wanting to keep some powder dry to see how the trade war, the sort of relationship with the US and any potential negotiations play out. But do you think that they should be stimulating more at this point?
Yeah, definitely. I think the best strategy for China is to, on the one hand, to resist the tariff by the U.S. I mean, China cannot just yield easily because Chinese leadership may believe that yielding easily, easy yielding could bring more tariff actually in the future. So that it turns to the domestic. It means that the government needs to stimulate the domestic economy more, especially when after the inflation over the weekend, we see that the household consumption is weaker than expected. Especially if you look at not only the core inflation, but if you look at the service side and if you look at the durable goods, it all points to the same way that the consumption is weaker than expected, even with the government's subsidy program ongoing, get renewed in January. Since January, the durable goods price still was going down, so that it means the domestic consumption was so weak.
There was not a lot in the MPC that sort of changed the broader picture, right? Does this tell you about the capacity that the government has or just the restraints that we're still seeing when it comes to the approach?
Yes. Overall speaking, we think the stimulus presented in the MPC was in line with the market expectation with the overall fiscal budget deficit at 8% of the GDP. But in our view, it can be even higher because of the debt swap. Local government debt swap started from last year. It can save about 140 billion yuan for this year, so that could be another room for the government to use to stimulate the economy. And also, we think they preserved some fiscal room in the future because if the tariff war goes even more intensified, the government can use that room to stimulate the economy.
And of course, you see the stock market continuing to rally and outperform the US, largely based on the enthusiasm for the private sector and tech revival. Are you as bullish in terms of the contribution to the broader economic rebound, do you think?
Yes. I think at least it can help the confidence side of the economy. And of course, if you look at the stock market, you can find that this round of rally in the stock market was mainly led by tech stocks, but not the overall stocks. If you look at the non-tech ones, the rise of that kind of stocks was a bit limited, but still it can lift the confidence. We have been talking with the investors in the domestic market to find that yes, their confidence was boomed significantly. But the question is how and to what extent it can help the economy. I mean, if the manufacturing sector is facing the headwind from the tariff and also the weak consumption by the domestic households, we still need more policy help to lift the non-tech sectors, especially in the traditional manufacturing sectors. I think the producers need more help.
David Xu from Bloomberg Economics and also our China correspondent Min Lo, they're joining us from Beijing. We'll be talking consumption in China with PepsiCo's APAC CEO, and so a little bit later she'll be joining us exclusively to talk about some of the trends and challenges she's seeing across the region. Also ahead, Coinbase and Chainalysis will be giving us their outlook for Asia's crypto market after the US moves to create a strategic Bitcoin reserve. This is Bloomberg. Concerns about the health of the US economy, the impact of trade tariffs weighing on risk appetite, and the downturn in risky assets is adding further pressure when it comes to crypto. Avril Hong has more. And Avril, this slump in prices coming despite Trump's policies, of course, for a long time being seen as being long-time supportive of digital assets.
Indeed. I mean, we've seen that Trump trade and how it's played out since November, but we're seeing a bit of a slump in cryptos. I mean, in recent days, we've seen Trump kind of suggesting legislative efforts for regulatory framework for stablecoin, signing on to this strategic Bitcoin reserve, although it doesn't seem to be entailing fresh Bitcoin purchases. And then he's also given industry executives a literal seat at the table with that summit in Washington. But despite this, we've still been seeing the pressure, including on Bitcoin, not far from the 80,000 handle, as some say that, yeah, long-term supportive, but so far it does feel like industry players are a bit disappointed from the moves from Trump so far. Flip the board again, we are also going to be tracking in terms of direction for the crypto complex, Ethereum in general, because if you look at in late February, what helped to sort of set the pace before we saw broader declines in the crypto complex was Ethereum moves. And we saw it over the weekend moving below the 2,000 handle, so not quite a good sign. And amid all this, of course, we've also been seeing cryptos having this increasing correlation, that surging correlation to riskier assets, including US stocks such as technology. And of course, for the industry, there's also a bit of that Bybit hack overhang still. So there are these continued headwinds, Heidi.
Avril there with some of the details that we've been seeing. And let's get some more insight now into how the Trump presidency might impact the broader crypto landscape. Joining us now is Hassan Ahmed, who's a country director and CEO of Singapore at Coinbase, which is, of course, the biggest crypto exchange in the US. And also along with us is Jason Somensatto, who's a head of policy for North America at Chainalysis, which is a blockchain data platform. Really, really great to have you both with us to talk more about this. And Jason, perhaps I'll start off with you in terms of some of the data that you've seen. Has it surprised you that we've seen such a downsized reaction, given we know that even putting aside the latest news flow about the strategic reserve, we know that President Trump has always been very supportive of this area?
Yeah, I guess it's a bit surprising. I think that people are expecting that like long-term support that you talked about, and there's been a lot of effort toward putting legislation in place that would change the regulations here in the U.S., but that's obviously going to take quite a bit of time. And I think in the interim, you see quite a few people trying to predict what the next thing out of the Trump White House might be, in particular this past week related to the new reserve and guessing, is the government going to be putting its balance sheet behind crypto or not? And so I guess I'm not too surprised to see some of the volatility. That's pretty natural in the crypto market. But I think the bigger question is whether all of these efforts long-term are going to see some fruit.
Hassan, what are your views? Have you been surprised, or is this sort of a broader, being driven more broadly by overall market sentiment and sort of the broader concerns that are driving, the other sort of risk asset downturn that we're seeing in the US?
Yeah, that's where I'm seeing this, that it's more the latter than the former. We're in this macro malaise sort of phase where there's just much more focus on fiscal policy, tariffs, rate cuts, the government U.S. debt maturing this year. And I think the market has to climb that wall of worry for all risk assets. And I think that's mostly what my sense is driving the short-term price action. However, long-term, we think that this is incredibly bullish and just fundamentally sound for the whole digital assets industry, and we're excited to see that theme play out over the long term.
How big are the implications when it comes to some of the US-driven policies? And I ask this question to you, Hassan, when it comes to what we see in the Asia-Pac area.
So Heidi, it's a huge regulatory and structural unlock for the global industry, but there are new considerations. So because of the weight of the U.S., things like Operation Choke Point 2.0, which really had a chilling effect on the whole industry, where counterparties were just not able to settle, There's also considerations around the long reach of law enforcement that the U.S. had and all the lawfare that was going on. For big corporations that have big distributions, they were just not interested to take on that kind of franchise risk to be able to add digital assets. We think that all of that is not only just going away, but it's a 180-degree shift where the U.S. is leaning into crypto big time. And along with that and the strategic reserve, this really does reset the playing board, I think, across the board. So all jurisdictions and hubs should take a fresh look at their policies. For the G20 and even hubs like Singapore, I think creating a strategic Bitcoin reserve is a smart idea, and it's something that they should be taking a closer look at.
Jason, I think you think that this is also an important first step, right? But you also suggest that further work and investment needs to be done by the US government?
Yeah, I think, as Hassan mentioned, this is a pretty big 180 for the U.S. government in terms of leaning into this industry and taking on, potentially new regulatory structures. And I think in that environment, you're likely going to see a lot more volume and a lot more activity in this market. And that's going to require quite a bit of capacity within the government to be able to, to make sure that regulators are up to speed on this technology, have their own technology in place to be able to address the risks that come with this. I think there's quite a lot still to be done in terms of building out that infrastructure within the government to be able to kind of manage the risks appropriately. I think the strategic reserve is an interesting first step because it provides that opportunity to say, okay, government, you're going to have to manage some of this crypto yourself and think about what that means and how to put in place the data and the technology necessary to do that.
Hassan, do you think this means that the kind of center of gravity changes when it comes to what's driving policies now coming from the US? And what does that mean in terms of business planning, in terms of hiring within Asia and other parts of the world? Does that have an implication?
Yeah, we have to remember this is still within the first 60 days of the new administration in the US. So it is early innings. We're very encouraged by the tone, the weight that the administration is putting behind this whole industry. It's elevated the importance of the industry to align better with the potential of this technology. So those are all very strong tailwinds that we are very encouraged by. As a result of that, Coinbase has announced that we are adding 1,000 new jobs in the US. However, to be candid, some of that is just catch-up, frankly, from the last few years, where other international jurisdictions which had better regulatory clarity, we were able to hire just with a much longer-term view. So those are all, somewhat of catch-up. And then the other part of this is also that we had actually, with the SEC lawsuits, spent about $50 million in just legal fees alone. So we're excited to be able to allocate that capital and that focus back into core product and services to be able to service our users better, not just in the US, but worldwide. Internationally, our plans remain unchanged. We're very excited about international expansion. In fact, this US de-risking probably gives us more leverage and just more clarity to go accelerate that. In Singapore, we announced an engineering hub in partnership with the Economic Development Board of Singapore last year, and we have been doubling down on that, on hiring the best blockchain engineering talent in this region that we can.
Hassan, I did want to follow up. When it comes to the 1,000 or more people that Coinbase plans to add this year, what's sort of the geographic breakdown? Can you share that with us?
Well, that 1,000 is slated for just the U.S. And as I mentioned, that's based on some new products and just some catch-up that we had been wanting to do. But the lack of regulatory clarity and just clear rules of the road were holding us back. We've announced some of those key product initiatives, such as being able to add things like DeFi lending into our core Coinbase application. Those are all exciting prospects and access that we're providing to our customer base, which will require just more R&D, more application level product hires. And so that's happening a lot in the US. Separate from that, we have our own international roadmap that we're pursuing. In APAC, we have about 800 staff across our sites in APAC, and we are continuing to hire at a pretty rapid pace in APAC, in EU, and other regions that we serve.
Jason, as we've sort of concluded, this is just getting started when it comes to what we could potentially see in terms of policy direction, right? What else would you like to see in terms of some of the reforms? And do you think we're now at a point where, with that policy being driven out of the US, that some of the Asian jurisdictions or global jurisdictions need to be doing the same?
Yeah, so I think the two biggest policy goals for the administration, and definitely the two most important in my mind, are getting legislation across the line for both creating a stablecoin framework in the U.S. and creating a market structure, a federal market structure regime that splits up authority between the SEC and CFTC. So much of the industry has been regulated at a kind of state level, and inconsistent regulations across those states that really want to take those two markets and create the structure at a federal level. I think when it comes to the impact on some of the APAC regions, I think the crypto market is inherently global. We already see that. And financial markets more broadly are clearly global. And, where you see with a lot of traditional financial markets, the ability to have international standards and agreements and organizations that ease those barriers between trade, I think the same is going to be necessary for crypto. So yes, I think it's going to be important for Asian regulators to at least find regimes, and I think they have been. In some ways, they've been more forward-leaning than the U.S. has been historically, but now is going to be a really important moment to find how to harmonize all these regimes together.
Yes.
Hassan, before we leave this conversation, I wanted to get your views on the Circle IPO. Do you have a gauge of sort of timing and how it could play out?
Yeah, I can't speak to sort of a specific issuance or specific company plans, but overall, I think what we're anticipating is once the markets start to be a bit more risk on again, I think the IPO window and the issuance window will most likely sort of open up and be favorable for issuers. There's many other digital assets companies that are also eyeing the same window. But I do think that, again, we have to get through this sort of macro patch is the sense before I think that the markets, the animal spirits start coming back.
Hassan, really great to have you with us. Jason too. Hassan Ahmed of Coinbase and Jason Somensatto of Chainalysis. They're talking all things crypto and reacting to that US moves when it comes to the strategic reserve. Coming up on Insight, we'll be talking about consumption trends across Asia, but in particular when it comes to the view on China. Pepsico's APAC CEO Ahmed joins us. Also taking a look at the strategies for growth at a time when consumers are searching for healthier options. This is Bloomberg. Welcome back. You're watching Insight. China's latest inflation data highlighting the need for more economic support from Beijing, coming at a time as the country grapples with increased trade tensions with the US and a number of other partners. In the meantime, Beijing is imposing levies on a range of US and Canadian products. And Avril Hong joins us for more on this. And we've already seen, Avril, some of that market reaction.
Including on some of the soft commodity futures, canola among them. I mean, it is moving by the exchange's limit, $28 a ton down, and to the lowest level since December, by the most since the middle of 2022, these canola prices. And this is following on from China over the weekend announcing these tariffs retaliatory against Canada, not just on rapeseed, but also on pork and some seafood imports. And interestingly, coming on the day today when these tariffs on US farm products also go into effect for the board, because as you say, we saw China's CPI below zero for the first time in more than a year. And this is coming not just from services, but also consumer goods. And a big pain point was food, 3.3% down after rising the prior month. And what's interesting about this, as some of our analysts have been highlighting, is that amid the dismal recovery in the Chinese economy, it's interesting how there's been a bit of a bright spot in food surplus oversupply. So that goes some way in explaining why China is willing to use food and food levies as a sort of tool, a countermeasure in these trade tensions, Heidi.
I was like,
Avril, they're giving some much needed context there and really setting us up perfectly for our next conversation. Exclusively, we now go to Ansa, who's the CEO APAC at Pepsico. She joins us for her first television interview since taking on the role just in January 2025. Previously, she was the CEO of Pepsico for Greater China, covering the beverage and foods operations. And really great to have you with us. And such an interesting but, albeit no doubt challenging time for your business. Give us an indication of sort of how you're dealing with the global uncertainties, the geopolitical uncertainties, the trade uncertainties as plaguing a lot of these consumer and export-oriented businesses right now.
Sure. Thank you so much, Heidi, for having me on the show today. It's an exciting time to be leading our team in the Asia-Pacific region. And as you just pointed out earlier, it is and still early in the year, but we're already seeing opportunities and yet also challenges for us in the region. Now, there are a global sense of economic uncertainty heading into 2025, as the consumer price index have indicated yesterday is probably not entirely unexpected, especially when you couple that with the Chinese New Year timing impact, where this year, February, it is a post-festival clearance, lapping the prime shopping season last year. So a lot of things that is going on at the moment. Now, what we should also be prepared always is the shift in all these consumer sentiment. And we believe that here in APAC, we're really focusing on the long-term growth aspect and also the resilient performance of our categories. It is a very diverse region. There are different pockets in the market, and so is there different pockets of consumers in our market. So we are really leaning forward with the pockets of growth, and then we are building a very, very resilient supply chain ourselves to weather through some of these macroeconomic headwinds as we navigate the year.
Tell us a little bit more about the I guess, the vulnerabilities, but also how you're building up resilience in, say, supply chains in the case of a worsening global trade war, as well as how you manage costs at a time where we're seeing a lot of volatility in materials prices, in soft agricultural commodities prices and the such.
Yeah, our supply chain is very resilient. First of all, because it is highly local. It's a very, very domestic-driven supply chain with high reliance on global supply, but mostly on also domestic suppliers and production network. Our supply chain is very well positioned to hedge against these global trade volatilities. And then we're also leaning in with a lot of our productivity measures using digital AI-enabled technologies to help us unleash these productivities and reinvest the value back into our consumers. And also we are constantly reinventing the way that we operate our business to try to find productivities. Some of the commodities we're actually well covered. So as we look into the future, we'll also be diversifying our portfolio so that we also hedge our risk.
How is the difficulties in sustaining confidence in the Chinese consumer being expressed in your business, right? Are you seeing an impact when it comes to household and consumer preferences and what they're consuming and buying?
Yeah, I think what you see is that the China market is still a very big market, scalable market with a lot of headspace. We are definitely seeing short-term volatilities, as you alluded to earlier on, but we are also seeing very, very strong pockets of growth. For example, in the lower tier, in some of the channels, as well as with some of the consumers being very keen and being very curious in constantly looking for new experiences and products, be it local preferences, be it a more permissible, functional, and also premium experiences as well. So as we look at the China market overall, one is to continue to always stay long-term, committed to the long-term prospect, and also be our short-term resilience, and also lean forward with a couple of areas. The first one is really innovation, which plays a very, very important part of our growth strategy, innovating against the evolving consumer needs, against also also an increasingly stratified and sophisticated consumer. You look at the burgeoning middle class, you look at the urbanization that is still going on in China. These present a lot of good opportunities for us to innovate against. We're also doing a lot in our omnipresence, touch points, especially with the digital touch points. We call it digital first, but omnipresence. And this is an area where we can really drive incremental penetration, incremental frequency, and resilience and salience of our brand. When it comes to innovation, we are also doing a lot across permissibility, functional, and premium. So we're investing in a lot of technologies to try to stay very relevant as consumer pivot their choices to align with an increasing lifestyle. So a lot of this is very robust. We will remain very robust and confident with the long-term aspect, while obviously staying very resilient with the short-term challenges that we may have to confront.
You talked about changing preferences, keeping on top of the latest consumer trends, and one of them is obviously wellness and sort of healthier options. And of course, part of that has been the global Ozempic effect, if you will. How is that impacting your business and your sort of product line in terms of how you're strategizing and how you're prioritizing certain types of goods?
Yeah, as I alluded to earlier, the Asian consumers, they're super curious, they're very stratified, and they're keen to explore new experiences. So these are the real genesis as we think about our innovation. And at the heart of it, our focus is to build iconic brands, elevated innovations, and provide meaningful food and beverages experiences to our consumers. Now, when it comes to branding, first of all, we make sure that our brands are consumer love marks. They bring deep salience and cultural resonance. And also when it comes to innovation, we are diversifying our portfolio to address divergent and evolving needs. A lot of these needs could be local, as you also talked about, permissible and functional, and also premium. To give you an example, we're investing in advanced technology that will help us reduce sugar, sodium, and sat fat. These are very, very important trends for our consumers. And on the other hand, we're also enhancing our functionality with the use of interestingly Eastern food homology ingredients, such as the black sesame, the jujube, and then the wolfberry. Some of these ingredients are also giving consumer real good benefits. We're also elevating some of our exploration in the fermentation processes, as an example, and these will help us drive benefits such as gut health. So all these are very relevant to the consumer concern around health and wellness, and we believe that not only investing behind the advanced technology, but also the speed of our innovations will allow us to constantly stay at the frontier of these trends.
We've seen an explosion when it comes to bubble tea chains, coffee chains quite recently in China. Has that impacted demand when it comes to bottled beverages at all, and how would you counter that?
Yeah, so these are also part of the new experience that the consumer talked about constantly. And then we see all these are really just underpinning the curiosity, the stratification of the consumers. And as a result, again, innovating against elevated experience is one prime job to be done in our business. We are looking at the consumer actually having very, very demand moments. Some, they will need crafted beverages to help, but a lot of those occasions, they're still leaning against the packaged food and beverage for its convenience, for its affordability, and also for its constant innovation. To give you one example, in China, we have a Pepsico Tai Chi series. This is how we actually feature botanical ingredients like osmanthus that is uniquely Chinese. Examples like this, we're constantly innovating against, and these are also our way of constantly elevating our brand experience for the consumers that we serve.
You talked about sort of the strategies being applied at a time where overall sentiment is quite weak by consumers and competition is fierce, right, when it comes to pricing. So I'm curious in terms of what you think, upon reflection, the most successful strategies have been in your strongest product groups.
Yeah, I think for our category, the key thing is still innovation, and it's about brand reach and the brand intimacy with our consumer. If you look at the China market, and quite frankly the entire APAC market at large, there's layers of growth drivers that can happen all at the same time. There's a lot of consumers that are still going into the consuming class, from the non-consuming to the consuming. A lot of them are going from the unpackaged to the packaged experience. A lot of them are actually going from the basic, simple experience to more elevated, and from singular occasions to multiple occasions. So if you imagine all these forces at play, a lot of our innovations is really doing it in a methodical way, how we actually crack these penetration, frequency, and premiumization gain. I talked about how the China market, and quite frankly, the APAC market has a lot of different pockets of growth. So as you see in the past couple of years, many of our innovation, or even the core business that is very delivering very robust growth, come from consistently driving penetration against the different cohorts with the right products at the right place. This, I would say, is the number one strategy and the number one proven playbook that we have done. Going forward, we'll continue to elevate these experiences, provide quality, innovative, and locally relevant product at the right speed. As we think about innovation, localization is another key lever. We're actually doing quite a lot to drive local sensorial preferences, and then to deliver local love marks.
And I also wanted to quickly ask about the company's broader direction when it comes to diversity, equity, and inclusion initiatives. Obviously, it's one of the many companies that have withdrawn from that effort in the United States. Can I ask what the implications are for your region? Because obviously, there's not so much of the legal pressure necessarily to do that.
Well, at the heart of it, inclusion is always an important part of the PepsiCo values. We operate in highly diverse markets, and we need to reflect the diversity that we operate, with the consumer, but also internally in the organization. So we embed inclusion as how we build our teams, drive growth, and also engage with our community. And this is the new strategy that we have been sharing with everyone, externally and internally, across three different pillars: the people, the business, and our community. So we'll continue to really embed inclusion in the way that we do things, and then we are very, very committed to that.
Can you tell us a little bit more about some of the sustainability efforts that PepsiCo is also pursuing?
Yeah, sustainability is really at the core of our business strategy. We call it PepsiCo Positive, and then we really have a long-term commitment to it. It is really an end-to-end business roadmap that we ensure that we create value and growth by operating within the planetary boundaries, and also inspire positive changes in the ecosystem that we operate, with all of our supply chain and agro partners end to end. And then the three pillars that we are really looking at are three areas. One is responsible sourcing and regenerative agro practices. Second is sustainable value chain. And then the third one is about providing positive choices to our consumer. Now, some of our continuous and very notable efforts in the region is around investing in the use of regenerative agro practices, use of renewable energy, reducing emission across the facilities in APAC, and we are also advocating a lot of circular packaging. Interestingly, we also believe in collaboration for innovation. So our Greenhouse Accelerator program, which is a very well-known program in the region and is already running for a couple of years, is a platform by virtue of partnering with innovative startups, VC, research institutes, and even stakeholders. So we are really driving a lot of that to co-create disruptive solutions.
And really great to have you with us, Ansa, who's the CEO APAC at Pepsico, joining us exclusively with that conversation. Well, coming up, Indian stocks struggling to find their footing after an unprecedented losing streak. We have the latest next. This is Bloomberg. Take a look at the start of trading this week when it comes to Indian markets. And of course, we have been struggling for some time now, but a little bit of hope when it comes to consumption stocks in particular. The narrative around India close to reducing its goods and services tax rates, looking like it could benefit some of those consumer durables, discretionaries and staple stocks in particular. Not really much of a move to the upside, but broadly in the green so far. Well, stocks in India have wiped out, though, over $1 trillion from their market value, and global fund managers are also not in any rush to load up on India as they gravitate towards cheap Chinese equities instead. Bloomberg Asia Equities reporter CJ Chakraborty joins us now from Mumbai, and of course, we've been talking a lot about the outperformance when it comes to Chinese equities compared to the US, and it seems like it's the preferred choice within emerging markets as well, and not India.
Yeah, I mean, the tables have turned quite a bit over the past 6 months. If you remember, back in 2023, 2024, it was all about money rotating out of China and into India. But it seems like India's growth slowdown, which is now into its third quarter, and with FPIs pulling out money quite rapidly, it seems that rotation has reversed quite strongly, especially since the beginning of this year, as Chinese equities continue to surge higher.
What is the outlook, though? Because the analysts that we speak to, sort of laugh. They say the two biggest questions are asked is, does this China rally have more legs? And when is India going to turn around?
Yeah, I mean, those are the two very important questions in the mind of most of Asian fund managers at this point of time. If you look at technicals, yes, there is evidence of some sort of bottoming out for Indian stocks, but the fundamentals are clearly not adding up yet. Valuations have come off from a recent peak of 21 times 1 year forward to about 18 times, so which has made a case for an attractive entry point, but growth remains quite slow and corporate earnings are seeing downgrades. So fundamentally, fund managers are still not convinced, but technically some grounds for a bottom in place.
Our Bloomberg Asia Equities reporter CJ Chakraborty there in Mumbai. Well, India is currently seeing explosive growth in its luxury sector. One report expecting that market to triple in size to around $85 billion by 2030. It's of little surprise then that India's most prominent designer, Sabyasahi Mukherjee, is looking to grab a piece of that pie. In an interview with Bloomberg's Menaka Doshi, he explained why he's now shifting from wedding wear to more authentic luxury pieces.
Luxury businesses in their inception years are really valued on promise. Sabya might be a very irrelevant brand in terms of its revenue, but I think it is the most important brand in the country in terms of its reverence and in terms of its positioning and its opportunities. My father asked me when I was planning to be a designer that how far will this go? Because he wanted me to be a doctor and I didn't. And I told him, mark my words, I'm going to become India's biggest designer in the next 15 to 20 years. And then I'm going to build on from there. I'm going to become one of the biggest in the world. And I still maintain it. I'll tell you the reason why I say this with so much authority. Because the opportunity is in being Indian itself. Because, when I look at luxury today, worldwide it's failing. Because you're appropriating products from different parts of the world. Because you see, luxury really, when you look at luxury brands, the real premise of luxury brands is authenticity, provenance, and culture. Where else in the world can you find something that is more stronger than what India has to offer? For a long time, whatever we had was appropriated by the West. But today, with a more sensible, discerning, globally connected audience, they are going to buy luxury products from companies who have their provenance right. You're not going to buy a kimono from a French company, you're going to buy it from a Japanese company. So when luxury becomes about craft and handmade, I think India is going to start I won't even say breaking the glass ceiling, because we never needed to break the glass ceiling. But India is going to become the biggest in the business. And I want to ride that wave.
But I understand you're reconsidering some of this, that at this stage in your 25-year journey, you might be reviewing how core wedding wear is to your business. You might be considering pivoting away from this. Have I got that right?
Absolutely. I think the wedding industry in India is, as we know of it today, is breathing its last. There were very big weddings that happened in the country, and people said it's going to revolutionize the way Indians see weddings. But I think that will not be the case at all. When I look at this country, I see a plane full of people just hopping from weddings to weddings to weddings to weddings. And I have to ask myself a question: when do these people work? And if you look at the new generation of Indians, they don't have that privilege. You know, when you start working very hard for your money, irrespective of how rich you are, you're also conscious about consumption. When you become conscious about consumption, weddings, as we know today, you know, which at one point of time was the domain of the idle rich, is completely going to change.
Indian fashion designer Sabyasahi Mukherjee, they're speaking with Bloomberg's Manaka Doshi. Well, before we go, take a look at what we're expecting tomorrow. We'll be getting the outlook for the global economy from JP Morgan's head of emerging markets economics research. Jahangir Aziz will be joining us. Traders, of course, are awaiting key data this week, including inflation numbers from the US and India. That is it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.